Hello and welcome once again to SB Talks. Today is Monday, November 14th, and I am once again joined by our Chief Investment Officer, Ashley Owen, to run his rule across the markets. Amongst other things today, we'll be talking chaos in crypto markets, US inflation numbers, US election, and the outlook from here. Welcome, Ashley.
Welcome all, wherever you are in the world.
Now, Ashley, probably the biggest, well, without a doubt, the biggest event of last week in markets was the latest US inflation numbers. And while still high, the markets got very excited. And we saw the NASDAQ jump by almost 10% in the last couple of trading days of the week. Unpack that one for us, please.
Yes. Well, you had this massive inflation in the US, which was well and truly out of control before Russia. So the governments around the world tried to blame 70s inflation on OPEC and the oil prices was rampant well before that. And governments now, of course, that created inflation tried to pin the blame on Russia. So before Russia, US inflation was running above 5, 6, 7%, and Australian inflation was running well above as well. So and around the world. So Russia was the icing on the cake, but inflation is a problem created by too much money by government spending, deficit spending, and too much cheap money by central banks, and a bit of Russia.
So in reality, the peak of it was the pandemic and the flood of money that hit the market.
That's right.
The world in pandemic times.
So it's important to make that point every time we talk, because if you create inflation, if governments created inflation by deficit spending and zero interest rate policy and free money from central banks, they've got to recognize that and acknowledge that in order to bring it back. And so far they haven't. That's why the election's important. We'll get to in a second. So US inflation peaked. It was running above 5% before the war. Peaked at about 9 and a bit percent in June, for the June month year to the June, which is middle of the year. And it came down to 80%, and the number came down to 7.7, I think, headline inflation, and the underlying inflation, which excludes fuel and food. The core inflation, which is a more important number for policymakers in the US, that came in at about 6.3-ish%, which is lower than everyone is expecting.
Yeah, and I think it's probably worth contrasting then. One of the big limitations of inflation is it's at a 12-month trailing, so you're pulling in this huge period from some of it 9 months ago and some of it only a couple of months ago. The last quarter of numbers is starting to look quite a bit better than the first 6 months of that period.
That's right. So things like fuel, things like retail spending, things like travel, things like used car prices, they've all come off significantly over the last 2 or 3 months. So they've pulled down the inflation from a 9-ish to 8-ish to now to 7%, 7.7%. So the oil prices have fallen from $140 down to less than $80 now. So that's flowing through to pump prices, and the lower pump prices now in the US and around the world are pulling down the headline numbers in inflation, which is good. So don't forget that the inflation half-ish, or a good chunk, several chunks of the inflation are supply related, like Russia and Ukraine and ports closed, etc., and random weather events,
and even legacy from COVID shutdowns in China.
That's right. So a lot of those will and are being lifted in time, and we're seeing those come off. For example, oil has dropped 30, 40, 50% over the last 6 months, and that's flowing through to lower inflation numbers. So because the market is this herd of animals that sort of chase shadows and throws money all around the world. That's what the market is. Daily prices, or every minute there's a price, or every half second there's a price on most stocks. So they throw money at things, and something changes, they throw money next door. So they were expecting inflation, the core inflation, at 6.5. Friday night core inflation came in at 6.3. So they started to throw money back at the market. So Apple and Google and Facebook, everything jumped sort of 5-10% overnight. So that was there's been a mini bounce. I think on Friday the US market was up about 1%. So it's put on about 4. Markets around the world have put on about 4-ish% this month, albeit only half a month. Which comes
and the areas that bounced most late last week was the tech space that had been most beaten up realistically over the 6-9 months that went before. So it's still a long way down from where it was.
Yep. So the bubble stock. So it's just a return to growth. The world's going to grow at 20% per annum forever. So it's fun and games. So silly stuff. So that brings us to, a market still expensive, and we've covered this in depth over the last few months. So the US market being the driver of US tech and growth and profitless prosperity, all these startups and NFTs and all sorts of SPACs and all sorts of funny things. We'll get to cryptos in a second. That had this massive bubble prior to the COVID, and then after the COVID lockdowns, you had the COVID stimulus money, which was thrown at people who went and bought stuff. So all of that tech boom, with a minor hiccup in the 2020, this tech boom's been running post GFC for 12, 13, 14 years. That peaked at the start of this year, and then the interest rate hikes sort of clobbered that. So the US market, which is still 60% of global shares, top 10 stocks in the world are still US stocks. So US is very important as a driver of the overall global sentiment, which then flows through to countries like Australia. US market was horribly overpriced at the start of this year, given the sell-off of about 20-odd%. And I think today, US global market, US markets are down around about 16%, 17% for the year. All that's done really is take half the fluff off. So the US market, global markets generally dominated by the US, and similar sort of tech stocks in Japan and China, that is really come off from vastly overpriced to now moderately overpriced. So we're still we still haven't hit the normal line yet. The fair.
Is it worth unpacking that a little bit further and sort of differentiating by sector? Because we know obviously parts of the technology sector, as you've rightly articulated, got this assumption of zero cost of money forever, meant companies that had a very long lead time until they got profits could be supported.
That's right.
And that picture's dramatically changed. So how is different sectors placed now, having energy being the only perfect place to be this year, everything else really struggling?
Yes, fossil fuels are the only thing that's up this year. Oil and gas stocks and coal have done very well this year, burning the planet and milking this massive boom that has benefited them. It's temporarily short term. Some sectors of the global share market, including Australia, are cheap. Banks are cheap. Banks are trading on price earnings ratios of 10-ish, which is good. They're trading on dividend yields of 5, 6, 7, 8%, including franking in Australia. So they are cheap because they've been sold off in anticipation of a massive earnings crunch next year with bad debts and bankruptcy.
Write-downs and such things.
So that's right. So, but even if you look at the three banks, the three commercial banks reported over the last week, and CommBank reported for its June year, they reported in August. The banks are still sitting on super fine bad doubtful debt margins or provisions. So, Westpac wrote back some, which means it's expecting less bad debts than they were expecting before the announcement. So they're sitting on very fine bad debt provisions. So when the bankruptcies, if and when the bankruptcies hit Main Street, which is the expectation next year, 2023, globally in the US, those provisions will be used up, and they'll produce losses like they always do in recessions. But that is already been priced into the bank shares. So bank shares have already been written down, but they're still very cheap. Industrial shares, companies that make things. We don't do that in Australia, but global companies make things. US companies make things. They're quite cheap. They've been sold off in the anticipation of this cyclical slowdown next year. Telcos are quite cheap. They're paying good dividend yields nowadays. They're more defensive. Things like pharmaceutical shares are moderately priced. The only real sector which is really overpriced, which is dragging the whole US and global market up, is the Teslas and the Amazons and the Googles and the Facebooks and the Netflix and the like, and the Nvidias and all those sort of things, Adobe.
But they remain the largest market cap stocks in the whole index.
That's right. So you look at the top 10 stocks in the world, they're all of those I just mentioned, plus things like Berkshire Hathaway. And I think ExxonMobil has crept back into, ExxonMobil was for decades the largest company in the world, oil and gas. It's now crept back up into the top 10 simply because of the oil price boom. So the point is that globally, which is the US primarily, it is still in bubble territory, but it's come down half the fluff's been sold off. It's still a long way above fair value in total. Now, the reason why we talk about global sort of markets and glossing over sectors and stocks is because when the markets tank, like in 2020, everything tanked. When the markets rise and go into bubble territory, everything goes up. So the markets are generally led by and dictated by not logic and common sense and careful analysis of balance sheets, The market price is dictated by confidence. Everyone feels good, they throw money at stuff. Everyone feels bad, they take money out. So markets will lurch from overpriced to underpriced, regardless of actually individual merits of individual stocks. So when the US, for example, jumped 5.5% on Thursday night, the Australian market jumped 5%. No reason why. There's no reason why Westpac and Telstra and QBE are all of a sudden suddenly worth X% more. It makes no difference. They only report twice a year. So the actual change of the share price should only be once every 6 months or so when they announce something. But sentiment, just mad herds throwing money, is what dictates share prices.
So I think what also you'll see in these big swings, and it probably brings us on to one of the next bullet points, is that you'll get these rationality points, or these rationalization to say that actually there's like a trigger event or a series of events that causes things that were irrationally either sold down or bid up in terms of valuations to have a reality check moment, and then a particular reset on it. And what we see play out, particularly last week, it's been over the course of the year, but it's really started to come to a head heavily in the last week, is on the crypto market and the crypto exchanges, with FTX at the center of that, one of the largest and most pro-regulation exchanges basically no longer existing.
Yes, I'm just looking at this headline from Fortune magazine. It's like it's just pop finance.
It's a nice glossy.
It's a glossy thing. It's like Bloomberg. It's like all the other glossy, pretend finance magazines. Fortune magazine's been around for half a century and it's read by everybody. I'm just looking at the 1st of August edition, which is only 3 months and 11 days ago, whatever it is, 3 months and 13 days ago. The 1st of August edition has this big fat chubby face of this fellow called Sam Bankman.
SBF. Yeah, let's just go with SBF.
Worth $25 billion US. This is only 3 months ago. And it says, is he the next Warren Buffett? I mean, it's just silly stuff. Anyway, so this thing that he built when he was 27 called FTX, no idea what it is. It's a crypto exchange, no idea what that is. People have put in, it contains about $16 billion, which is big dollars, real dollars, US dollars, $16 billion of customer deposits or customer assets that he holds on behalf of customers. He stole about 10 billion of that over the weekend.
Allegedly.
Well, no, he says, first of all, he said it was hacked. Then he said, it wasn't hacked, I made a mistake. Then he said it was transferred to a what was the term he used? A vaguely named account, or a mistakenly labeled account, which turns out to be his own hedge fund called Alameda Capital, which is his own. So he's shuffling money between himself, and he ripped off. He stole $10 million on the weekend, and he said, "Oh, it's not my fault." He was the next, apparently 3 months ago, according to Fortune magazine, which is read by some people, the next Warren Buffett. Come on. Anyway, so it's probably the it's another one bites the dust. It's unfortunate that people, a lot of money, Telstra, for example, Telstra's got a venture capital, venture fund, kids running around with black T-shirts and funny hair. This is Telstra, which is the national broadband carrier. They invested 10 million for some unknown reason in this thing, so they've lost that money.
When you look at the register of some of the investors, they're not foolish companies. BlackRock, no, they're not in there. There's a number of sovereign wealth funds are in there. Like, these are Canadian pension funds. These are
correct.
So it's easy to be dismissive, but you have some seriously well-established and respected investment firms that are in there that have now seen complete wipeouts to their capital investment.
Yeah, it'll be more of that. We haven't seen the last of that. So there's still these things running around collecting people. Why people put money in these Bitcoin exchanges, I have no idea. It's just pure theft. It just goes into their pockets.
I think it's the perfect example of the bubble. If you talk about the South Sea company and things like that from 100 years ago, it's the same thing. If you're watching other people around you double their money, you feel like you're the idiot for not jumping in.
Well, when you get as old as I do, you end up writing the same old stories about the same old things. You just insert bubble here, insert fad here. It's the same. It is sad that there's actually quite a well-known private wealth firm in Australia which had clients sort of clambering over themselves to get in only of the last 6 months in a raising they did. So it is unfortunate to see, you and I go a lot of meetings, and you look them in the eye and say, where were you 10 years ago? The answer is you're in primary school with an abacus. They haven't seen a bubble yet. They haven't seen a bust yet. They haven't seen a recession yet. So COVID wasn't a recession. It was a recession economically, but the governments threw so much money at it, was gone within 2 weeks. So
and we're dealing with the fallout of all that now, and that
people,
really drove those hype bubbles. So it is, look, it's quite scary. You could jest and say we don't get that many crypto questions from clients anymore.
Not anymore. It's
months
falling.
Ago.
Yes.
But it's real money out there, and unfortunately, real people's investments and savings that are seeing total capital destruction.
It's a lot of FOMO, fear of missing out. They see their friends down at the baseball club or the golf club making money, so they say, well, I can do it too. That was prior to last year, but this was all in the last 6 months. So a lot of it's just FOMO, which is silly stuff, but a lot of it is genuine, boomers who thought they were going to live till 85 and work till 65, and they thought they were going to have plenty of money to continue their lifestyle. Boomers retiring at sort of 65 odd, they've still got $1 million in debt. Their super fund is not worth 3 million, it's worth 1 million. So they're realizing they've got to get it back. They've got to get rich quick, even though they're 60, 70 years old. They line up to throw money at these sort of things in order to get rich quick, to get it back, because they're going to live to 100 now, someone's telling them, and they're going to run out of money quick. So that the retired pension age pension in Australia is $40,230 combined if you're a couple, if you're a homeowner. And that still accounts for 70% of all retirees are on the pension for some reason, even after 30 years of compulsory super. So people are saying, I just need an extra million, throw money at this, throw money at that. Forgetting this common sense stuff. You don't get rich quick without risk, and there's your risk. So it's unfortunate to see, but we go to a lot of meetings and we just laugh at them, literally laugh at them, because they're just kids with no idea. But there's a lot of money being thrown at these, most of which will be lost. Unfortunate, but that's just a phase of the bubble.
Part of the investment cycle, unfortunately. Might step back to the US then, where we were talking inflation. The other big event in the US last week was midterm elections and the red tsunami. Everyone was preparing for the red tsunami to come.
It's funny how it turns out and I'm not really interested in politics, except for the market implications of how people feel about what's good or bad for markets and shares and bonds and inflation. So I always approach it from that point of view, rather than saying Democrats are good or Republicans are good or this guy's a clown. Doesn't matter. The best outcome for markets, don't forget, going back to the very first thing I said, is inflation. What caused it wasn't Russia. Inflation is caused by Congress throwing trillions at people's pockets who went and spent, which is inflationary, plus central banks dropping rates to zero and having these massive free loan programs to make people borrow. That's what caused inflation. So the good thing about this is that you've got, looks like the House has been won by the Republicans by a few seats, and the Senate is being retained by the Democrats. That's a good outcome, which means that Biden can't go mad and spend even more trillions he hasn't got. So that's actually a good outcome. So that's the reason why probably some of his more outlandish infrastructure bills and spending bills are not going to get through, or not going to get through in the same form. So that will probably slow down his deficit spending for the next 2 years, which is not a bad thing, but means
will likely influence the Fed in how far they feel they need to go in the short term. If they feel that this,
that's right.
If they're not having to push back against this liquidity surge, then they might not feel the need to keep going at 75 basis points.
That's right. So probably the Fed's had a few 75 basis points rises. So the sentiment this week or last week was turned to say a 50 basis point rise, and then maybe another 25 and 25. So you've got a lot of things going on. You've got the inflation coming down quicker than people expected. You've got the core inflation coming down, which is good. You've got unemployment's gone from 3.3-ish down to about 3.7. So unemployment around the world is drifting up. Even in Europe, it's drifting up again because there's been a slowdown. A lot of layoffs. Most layoffs now have been in the tech sector, which is a good thing. They weren't real jobs in the first place. But we're starting to see manufacturing companies, importing companies, distribution companies. We're starting construction companies, particularly in Australia. So we're seeing unemployment around the world rise. So you've got that happening. You've got the wages growth in the US, which has slowed now to about 3.7 growth year on year. So that's actually a lot slower than it was 3-6 months ago. So the wages growth, US wages have grown much more rapidly and earlier than Australian, which is a different story. So remember, 2 years ago in the middle of COVID, Amazon had to pay its staff 10% more. Walmart had to pay its staff. This is 2 years ago now. So the US wage inflation has slowed down to less than 4% per annum, which is slowing. Unemployment's rising, which is slowing. Core inflation is down, which is slowing. Headline inflation is down, which is slowing. So all of those things, plus you've got the Biden spending spree blocked by the divided Congress. So there's 5 factors there which go towards saying probably the Fed won't need to raise rates by another 3 or 4, 75 basis points. He may well pause. He said we're a long way from pause, but probably he's going to go for 50 basis points and maybe 25. Have a look over Christmas.
Yeah.
So
I'll have a chance just to take assessment of, we've done these rate rises in less than a 6-month period. So let's actually give a chance to assess what impact they've had on the economy. And I know your base case was never that we were necessarily heading back to 70s style inflation, but perhaps also there's an element of relief to say, well, if the inflation is cracking a bit, if some of the spending's calming down a bit, that the tail risk of that outcome is further decreasing as well.
It is. So I've always said we're not going to get back to double-digit inflation, which is endemic. We're going to get back to higher than average or higher than target inflation, and it'll probably stay around for longer than policymakers like. So and it really depends on how it changes people's behaviour. And I've found this. I've talked about this before. When you go to the shops and buy 3 boxes of X or 1 can of whatever, particularly non-perishables, if you're buying 1 can of something, you find yourself thinking, well, I know it's going to go up in a month or two. I might as well buy 2 cans. So that is the sort of thinking. It sounds easy when you say it quickly, but that sort of thinking, that change in thinking relative to the last decade where you just bought 1 can, the very low inflation decade to 20 years. Now people like me are saying, well, I'm just going to buy 3 of those instead of 1 because I know it's going to be more in 6 months. So that's inflationary. If a billion people around the world start to think like that and act like that at the supermarket, that's what inflation comes from. And that's where inflation, it's very hard to break that cycle of spending. So I think that's going to be one of the features of inflation in the next 5 or 10 years. It'll be higher than Fed's aiming for 1 or 2%. We will get a big deflation crunch next year if a big recession comes, but the core spending will keep going beyond that because recessions come and go and they rebound, but probably inflation above target will be a feature, which means we're going to have interest rates have to rise higher in order to kill that back to target. So it's going to be a tough job while Congress and parliaments around the world, like Australia, are still running big deficits, throwing money at people.
And if we come back a bit closer to home, the RBA has been eased off in its increases quite a bit sooner than the Fed. So we've sort of seen a couple of 25 basis point rises now. They're taking more of a tone of, let's see the impact that the increases that we've done from May to now have before we keep adding an extra 0.75% or 1% on top. And Australia, obviously, a lot of household debt in the system, so a lot of sensitivity to those rate rises.
Australia is one of the most sensitive countries in the world to changes in short-term rates because most of the mortgages out there are floating rate mortgages. By and large, over decades, about 80% of mortgages in Australia are floating rate. But over the last building boom, construction boom and housing boom we've had, which is now over, that jumped up to about 40% of new lending. So and of those, the 1 and 2 year fixed rates, they're all rolled off or are rolling off very soon. So a 2 year fixed rate for 3 years is going to jump up to, say, 5.5% floating rate. That will hurt a lot of people if they lose their job in a recession and a big slowdown if that occurs. So that's when you get pain in Main Street. So US is very different. US, almost all of their mortgages in the US, home mortgages, are based on a 30-year fixed rate, which started to rise 2 and a bit years ago. The middle of July, August 2020 were when rates bottom, long-term rates, bond yields bottom. And those 30-year fixed rate loans have been rising steadily for the last 2 years. So that pain is much more gradual and it's far less volatile than it is in Australia. I remember having an 14% mortgage in 1988, which went to up to 18% in less than 2 years at the end of 89, before the big recession we had to have, Keating's big recession we had to have. We won't get that again, but the speed of those rises we will get. And we've already seen rates go from 1.5%, 2% up to 5%, and probably another
in terms of the actual bank mortgage rates. Yeah.
Yes, that's right. Bank people paying. People rolling that have 2% 1-year loans or 2-year fixed rate loans, they're having to roll into 4.5% now, but probably 5, maybe 5.25%, 5.5%. Now that sounds scary to them, but you and I, that's normal. Pre-COVID and pre-GFC, interest rates were about, cash rates were about 4.5%, 4.75%, and mortgage rate to 6-7%. That's where we're heading. We might need to go higher than that first to kill inflation, but that normally we're going to head back to mortgage rates of 5, 6, 7%, which is just normal stuff, when cash rates of about 4%, which is normal. Now, I've been saying that for about 2 years, and people are laughing at me, but now we are near cash rates of 4%.
Well, the RBA, we're still talking about 2024 this time last year, so that's right. We don't need to probably revisit that one. I guess the one positive out of it all is for investors rather than borrowers, is that you're now getting paid an appropriate level of interest for the risk that you're taking in holding the assets. So
we had in our portfolios, we don't like fixed rate bonds, which is your traditional asset, defensive asset class, so-called defensive asset class. So we've had the vast majority of our defensive side of our portfolios in cash and cash-like products and securities, high-grade cash securities, which were paying 0. And they're now paying 3.5%, which is good, and it'll rise over the next year. So inflation,
3.5% above sort of having paid maybe 1.5 at the start of the year with a 0 interest rate, so you're now getting RBA plus 2 to 3%.
So good high grade floating rate corporate debt, corporate notes, high grade floating rate notes, corporate pay around about 1% or 1.5% above the cash rate, because they're based on the 90-day bill rate, which is effectively the cash rate almost. So they're now paying sort of 1.5-ish% on top of 3.5%, 4% in a few months. So that's actually a decent return. Now it's taxable, whereas dividends have got franking credits, but still it's good to have a nice stable cash return in a portfolio rather than returning nil like it was a couple of years ago. And
we were talking earlier, and you were mentioning world population growth about to tip over the 8 billion mark this month. By I'm not sure who's keeping the tally on that number. Is that you?
Well,
do you have a chart?
There's have I got a
sure chart? You have a chart.
Have I got a chart? The world population is it's good to sit back and think about some broader issues, because and it's important, because even if you're 65 and retired, one of you, wife or you, is going to live to 100. So all of a sudden you're now a long-term investor, even though you think you're going to play golf and pot a few plants and die. You're going to live to 100. So you are a long-term investor. So you've got to think about long-term asset classes and long-term returns, long-term inflation, long-term demographics. They're important for long-term returns. So the world is geared to growth. The whole mentality of humans striving for more, bigger, better, more. It's a mentality of growth. So that's dictated investment markets and the way companies spend capital and the way governments budget, for example. That's been seen this very slow turning point where we've now got population at 8 billion. China stopped growing. They've had a declining workforce since 2015. That's long gone. Japan's had a declining population and workforce for 10 years. So, and Northern Europe is declining. Now middle of Europe, Germany, France, they're declining, particularly when you've got immigration off the table. So for a whole lot of reasons, demographics and immigration, you've got slowing and plateauing. So the world will probably hit about 9 billion odd people, 9.5 billion maybe later on this in a couple of decades time, then start to slow. Now that's that's scary, but that's in 20, 30 years time. What we can say today is, and I think the actual date it ticks over is tomorrow, the 15th of November, based on the averages during the year. But that's when 8 billion is hit. And also importantly, that's when the peak, we're in peak baby. Today, or tomorrow, is peak baby. So as at tomorrow, after tomorrow, for the end of humanity, which is quite a long time, there will never be more babies on the planet ever again than there are now.
Right.
And that, of course, demographics being what it is, it flows through very, one of the great predictables is if someone's born now today, I can predict with reasonable certainty they're going to be 10 in 10 years' time. They're going to be 20 in 20 years' time.
Enter the workforce in 20 to
You can predict
25
their
years.
spending and working patterns quite well. And demographics is one of the great certainties of the world. Now, there are things like pandemics, 1300s, and the world population collapsed by about a third in the Black Death in the 1300s. You had COVID, you got things that go on, you got wars. But short of that, demographics is one of the great predictables. So if you start to think about one implication, for example, is you've got declining workforces. Now, the retirement age has gradually been lifted from 55, 60, 63, 68. So that will increase, but people can't work forever. A lot of people can't work. They haven't got their physical skills, their eyesight, their hearing. So a lot of people can't choose when they retire. They have to retire or change their work, their work habits and their work skills. Some can, some can't. So you have an aging population, declining or less growth in the workforces. That means you've got to look at your pension system and how that is funded by your working age population. So the balance between workers and those living off the workers, i.e. the pensioners, is going to get far more tricky as time goes on, because budgets are set by politicians and politicians are elected, and more of the vote's a grey vote, and therefore you're going to have... So the impact of all of that is probably more government debt and more deficits and more pain for those unskilled or less skilled workers. So that changes a lot of things in portfolios with inflation. There'll be fewer jobs, there'll be a fewer working population, so there'll be a shortage of jobs. Now, you see that in COVID where you simply can't find staff. I think that'll be, get rid of the COVID, which is a short-term thing. The declining workforce supporting a larger older population means we'll have less ability to find workers and pay workers. So that'll be inflationary. At the same time, you've got productivity growth and you've got scientific advancements which will bring down the cost of food. People are eating less. The world basket of food, is the demand on that is going to decline. So the falling food prices that we've had over the last century will continue, which is good. So you won't have those culture wars and those food wars where countries fight each other over food, which is a great fear of the 70s. So that'll turn the reverse. So at the same time, you've got there's trading blocks. You've got China with its block it's building. You've got the US with its block it's built, and NATO. So that will start to increase. You've got increasing medical spending for the age, but you've got increasing defence spending. So that means it's good for commodity providers like rock diggers like Australia. So there's lots of nuances in this, but it's good to sit back. Christmas is a good time to sit back and say, well, forget the next year or two. What's the world going to look like for investors over the next 20, 30 years? Because that's us. Like it or not, we're going to be there in 20, 30 years' time having to invest portfolios.
So where to from here? You run into the end of the year. We talked before about some of the market rebounds last week. You're happy not to be 100% back into equities just yet?
We have in our portfolios, we're pretty full on shares. We didn't go massively underweight shares. They've done quite well, and we've got some defensive allocations in portfolios. We've got some infrastructure in portfolios. We've got some alternative strategies in portfolios which have done well during the sell-off. So we changed to Australian share funds in our Australian share fund mix of sort of 6 share funds, and they're doing quite well. We're probably going to sit on that. We'll have a look through Christmas. I suspect that globally the sentiment is now bullish, but I think there's lots of things that could go wrong. Yeah. We're still in overpriced territory for most of the big sectors, the US tech sector in particular, tech and online social media, online retailing, the Amazons, the Facebooks of the world. So they are still overpriced. The Teslas of the world, Netflix of the world, they've literally run out of room to grow, but they're still priced on, even Apple and Microsoft are priced on price earnings ratios of 25 times plus, which means they've got to keep growing at sort of 5 or 10%. The world population, the world demand for machines and technology and software, they're priced as if that world demand will increase by double digits forever. They won't. So they're going to have to turn into mature industrials churning out same old stuff. And the new breed of tech will have to come along and take their place in the next several years' time. So I think there's quite a bit of potential for some negative surprises to take the win, given that we're still in overpriced territory.
So you're talking about a lot of discussion there about company profit reporting and companies having to, I guess, open the doors and admit that some of the growth that's been baked in is just overly optimistic.
A lot of assets have been overpriced, have been valued up. We're going to see those valued down. We've seen a lot of layoffs in the last, say, 2 months in particular. In my monthly report last time, I said next stop profit downgrades. So I think we're going to see some, not necessarily in Australia, because we've already got the BHP, Rio, Fortescue. They've already downgraded based on the iron ore price coming down. So looking beyond those into real companies that do things, I suspect that around the world we'll see some downgrades in the outlandish profits. US profits are still, they've come off their 10-15% growth curve and they're now flat. I suspect we'll see some of those start to post some downgrades in profit outlooks. That's not a bad thing because the share price is already down based on that's happening. So the unlikely case is that we will avoid all global slowdowns next year. Share prices will jump back up to where they were and we're back in the boom again. I don't think, I suspect we're sort of halfway into a 2000, 2002 tech wreck because that's what's been driving the bubble north. It's come off halfway. I suspect in terms of timing, we're probably around about 2001 with still quite a bit of downside to come with the overpriced sectors of the market.
So we're happy to maintain that Australian exposure, happy to maintain some of that defensiveness around our international exposure and proceed with caution.
Correct.
Excellent. As always, Ashley, thank you very much for the many insights and the colourful contributions. Until next time.
Thank you very much. Good evening.
Take care. Thank you. Thank you to all the listeners. Speak soon.